Well, hello, everybody. Welcome to Wall Street Hackers on the IBM TV Pod TV network. I'm Nick Palavita. I'll be your moderator and one of the panelists today. And of course, today we're going to look up and down what's going on in Wall Street and the stock market. And with that, we have a person who graduated from UCLA with a degree in economics, a law degree from the University of Miami, and also a master's degree in business administration from NYU in New York, spending 17 years on Wall Street. He'll give us some insights and of what is going on Wall Street, including stories of the week, quotes of the week, and of course, Peter's picks of the week. And with that, we're going to bring in the hacker himself, Peter Bennett. Peter, take it away.
Good afternoon, Nick. Hello, audience. So you can catch Wall Street Hackers almost every week. Sometimes we take a week or two off, but most weeks of the year, we have a new one coming on. Thursdays on most distribution channels, possibly Saturday on Spotify and iHeartRadio. So first, we always go into the markets, and the market was very happy with the inflation numbers in June, but it doesn't matter. They're just always looking for the right encouraging data. So they saw the CPI was 3% year over year, which was a nice improvement, and the core CPI was up 4.8%, which was lower than expected, and also the smallest since June 21. So, okay, the market's happy, but what's the market missing? Number one, and the thing is, nobody knows when, where the market will go, obviously, but the thing is, core inflation is 4.8%, and that's one of the Fed's main measures, and they want to get it to 2. So is the Fed done? Well, they're projecting about 88% for July increase. I think it's coming. I've been saying that. Then only about a 25% for September for an increase. So the Fed could be getting near done, or they may not be. Nobody knows that. That's why it's always changing the odds. But number one, core inflation is 4.8, and they need to get it to 2. That's far from it. Number two, unemployment is still at 3.6%. They haven't even made a dent in unemployment. It's at a 50-year low, and that's going to drive inflation. Number three, services inflation came in at 0.5% for the month. This is not good at all. 6% annualized. I don't know how the market can ignore that. The government has still a tsunami of fiscal stimulus. There are so many bills that were passed in the last few years, money pouring into green energy and different things that are going to stimulate the economy. Are they worth it? That's a separate debate. But the point is, it's stimulating the economy. And also, this is an interesting point somebody made. First of all, next year's an election year, everybody knows, but the Fed probably wants to get inflation under control by then, and they're going to have a lot of trouble raising next year. So they're probably going to want to err on the side of raising more this year to make sure they don't have to raise next year in the middle of an election year. And finally, the bull in the China shop, which I'm always talking about, I really think this is going to come to roost someday, is energy. So energy prices were down 16% year over year. Great, except for that's why the CPI is finally falling right now and core inflation fell, because energy drove a lot of the increase. Energy skyrocketed for a few years, and that drove inflation. And that's the history. When energy, 3 of the last 6 years, recessions were caused by high energy prices, and the market's reacting to them. Well, I don't think we're finished. I don't even think we're near finished. So in June, even though year over year energy prices were down, for the month they were up 0.6%. And that is going to catch up eventually, because let's say energy prices don't keep going up. And I'll tell you why I think they will, which is I'm always talking about that. But the point is, let's say they just stay flat. Well, now you're not going to get that energy effect of holding prices down, the energy factor. So when that's gone, and likely goes up. And why is it likely to go up? Well, one, I cannot believe the fact that energy companies are putting in less than 50% of capital year after year since 2015 in oil and gas projects. We know the reasons why. We've discussed them. ESG is going to 10% of their projects. If they're in terminal business, they're returning more to shareholders. Tons of regulations and restrictions from Biden administration in America, because of their green energy push, and also Europe. So the energy companies are going, okay, let's return more to shareholders. So they're not put less than 50% of what they used to put into projects. Now, these projects are 5 to 7 year projects. USAC, an old investment that I did well with, and I'm out of it now, although ET, which we're going to discuss this week, as a matter of fact, owns that, controls that. So anyway, USAC said in the conference call, they believe that oil and gas companies are putting 40% too little into oil and gas projects to keep production where it is, just flat. So let's say down the road, all of a sudden, we're 20, 30% or 40% short on oil, because for years and years, who knows when they'll start putting in enough, but this is going to catch up. 5 to 7 year projects. So probably not this year, but maybe next year. That will drive a huge change for inflation and everything else. And I think it's going to go up this summer a lot more than people expect. And so did Goldman Sachs, by the way. So energy is a cause. Unemployment is a cause, and government stimulation is a cause. So I'm not looking at the effects, which are lagging from the causes. I'm looking at the future causes and saying, very likely the fight against inflation has a long way to go. We will see, but I'm very defensive in terms of the energy. Of course, in terms of the market, if the market goes up, I'll be fine, because I'm allocated to some stocks and a lot of energy. As a matter of fact, about 28%, 29% is our suggested allocation for energy this week. So quote of the week, it's a very interesting quote. It's non-financial. This is from Aidan Miller, he created a robot artist and synthetic panelist called AI-DA, ADA, I guess. Here's what he said. He said, tech rates advancement is, quote, astonishing. Where any skill is involved, computers will be able to do it better. That's the first point, by the way, about jobs replaced. But here's the amazing quote. AI and biotechnology are working together, and we are on the brink of being able to extend life to 150, 180 years old. And people are not even aware of that. Very few people are thinking about that. But that would have huge aspects in terms of society, in terms of financial planning, in terms of life. It would be unbelievable. And so next week, or in our next discussion, assuming we can finish this week's, we're going to discuss some of the implications of that. People potentially living 150 to 180 years. By the way, a footnote on that is, I think it's going to happen. It's just, will it happen in 10 years, 15 years, 5 years, 20 years, 30 years? But they are going to get there. So that's an amazing thing about AI. The 5 most interesting stories of the week. The first one, I'm always on this. I think the media in the United States and the world is so corrupt. Their goal, and a lot of them have admitted it, is to influence people, not to tell the truth or report things. So I'm talking about almost every station. And in this week, I'm going to indict every station just about, CNN, MSNBC, the mainstreams like ABC, NBC, and Bloomberg. So here's what they reported. They said on July 3rd, when we did have hot temperatures, they said, quote, we've reached, quote, record temperatures. Others said, we've hit record temperatures since recording began. Well, that is very misleading, not surprising. So here's an actual chart, and unfortunately I have to hold it up, sorry, of the last 65 million years of temperatures recorded. And this comes from the NOAA, which I believe is the National Ocean Administration, climate.gov, NOAA.gov. So you can see that we are nowhere near record temperatures. I also noticed, by the way, it did fluctuate more in the last million years, but we're at the low end by far. And you'll also notice the whole range is like -2 to +2 roughly in the last period of time, which goes from 5 to 0 million years. So there's been a lot of recent fluctuations, but also down. I don't know. I'm not taking a few footnotes. I'm not taking a position on global warming because this is a very complex issue, and I have seen arguments on both sides. So I'm not trying to tell that. What I'm trying to say is the meat is so misleading. So if you heard there's record temperatures, as long as they've been recording it, you'd go, oh my gosh, that's probably a million years or 10,000 years, or at least 100,000 years, right? Well, this fact was based on 44 years of records. They began the particular record keeping that they're talking about in 1979. So it's just another indictment of the media. They won't report stories they don't like. They slant stories in the way that it fits their narrative. It's just there's very little truth on there. Hopefully there is truth on Wall Street Hackers. I believe there is. We try to take a look at both sides of stories. And number two most interesting story, Hollywood, the shrinking blockbuster. So studios may need to rethink the summer blockbusters. They've had disappointing results from major and expensive projects. Elemental and from Walt Disney was a bomb, also because they got into woke issues. And people don't always want to see that, especially kids. For kids, Warner Brothers, The Flash saw, quote, an abysmal opening and failed to reach 100 million in domestic sales. Indiana Jones and Dial of Destiny cost 295 million, one of the most costliest film ever reported, and it brought in just 60 million in revenue in the first 3 days. By the way, a separate movie thing I just thought was interesting. The movie Barbie's coming out, and there's so much pink in the movie Barbie that there is a national shortage of pink paint and pink pigment. That's how much they used on the set. I'm not saying it's good or bad. I'm just saying it's a lot of pink for the money. So an interesting third story, fats can help hearts. This was a surprising story to me. So a study found that whole dairy, including cheese, whole yogurt, and whole milk, can actually help prevent heart attack, stroke, and cardiovascular disease. They also found, surprisingly, that unprocessed red meat can be part of a healthy diet. The Pure Diet, published in the European Heart Journal, finds 6 groups that are actually healthy, even though a lot of people think they're unhealthy. They said our results show up to 2 servings a day of dairy, mainly whole fat, can be included in a healthy diet. They also said that you can have a healthy diet with moderate consumption of grains and meats. Variation and variety is key. I would just point out that, of course, heart issues aren't the only issue with meat, but it does make me think maybe whole dairy is healthier than many people say, and unprocessed meat, not processed meats, but processed meats in moderation could be fine based on what they're saying. And I agree with that too, in moderation. Another story, insurers in a pickle. So the senior sports craze is slamming the health insurance industry. Earlier this month, United Healthcare, the nation's largest health insurer, warned that elective procedures like hip replacements and knee surgery were rising at a very rapid pace. And when they reported this, their stock went down 9% in a day. So a UBS analyst, a UBS financial analyst, said he attributed this to pickleball injuries and calculated that they're poised to cost $377 million this year. And pickleball surged 86% to 8.9 million players in 2022. And UBS is predicting it will spike to 22 million this year. So people are going crazy for pickleball. And they said that it could spark 250 to 500 million in healthcare capacity utilization in 2023. The most common injuries were strains, sprains, or fractures. So That's not, I don't know how to put it, but that's another inflation factor that could play down the road. Finally, we like to do a humorous story as our fifth story, and I thought this was pretty cute. So Ben and Jerry's Ice Cream called on the U.S. to give back, quote, stolen indigenous land, including Mount Rushmore. Ben and Jerry said, quote, the United States was founded on stolen indigenous land. This 4th of July, let's commit to returning it. They said we should, quote, start with Mount Rushmore. The faces on Mount Rushmore are the faces of men who actively work to destroy indigenous culture and ways of life. Now for the funny part. So the chief of the Nulhegan band of the Abenaki Nation, I think I'm saying it right, it's one of the 4 tribes descended from the Abenaki, are in Vermont. And they said that they want the ice cream makers' headquarters returned to them because it's on Abenaki land. He said they look forward to any kind of correspondence with the brand to see how they can better benefit the indigenous people. It said it should reach out to him as the company's corporate headquarters, located at 30 Community Drive in Burlington, Vermont. South Burlington is situated on Western Abenaki land. Okay, actions or words, Ben and Jerry's. Turn over the headquarters. You stole it. Thank you. Okay, we'll take a quick break and we'll talk about the investment of the week and also the panel discussion of the week. See you soon.
One of the things that business owners forget a lot is to prepare for their own retirement.
Hi, my name's Nick Palavita, and today I'm with a very special guest, a certified financial planner, a chartered retirement plan specialist, and president of National Pension Partners, Max Couliet. Max, tell me what you do at National Pension Partners.
Well, Nick, we help successful small businesses and professionals put together retirement plans that provide them the maximum retirement benefits and big tax deductions at the same time.
Well, how do you do this?
Well, we get on an internet conferencing system with the client. We review their goals, what they want to accomplish, and then put together strategies to help them in implementing a retirement plan that benefits them, not everybody else.
Well, that sounds really good, but how much does this cost?
Well, it's really not bad because the first consultation is free. That allows us to go through and discover whether this strategy works for that business and for you as the business owner and helping you maximize your retirement.
Well, Max, how do we get this free appointment?
It's really pretty simple, Nick. You can either go to our website below or call us at 877-252-1692, and then we can set up a time with either myself, Nick, or one of our other retirement plan specialists, another CPA or advisor in the office to go over this with you and make sure it fits for you.
Hi, my name is Lewis Haupt. I work with National Pension Partners, and I work with businesses to allow them to put the maximum away that they can for themselves and to save taxes.
Hi, I'm Brad Coyle, and I'm the brokerage manager at National Pension Partners. We're always analyzing plan fund choices in order to ensure the participant's success.
If you want more information on how we can help you and your business put more money away in a retirement plan than you ever thought possible, contact us at the website below or call us at 877-252.
Okay, and we're back. So this is our favorite chart. I'm going to have to hold it up again. Nick, if you could blow it up a second for the audience. So this is my favorite chart, and the theme, one of the themes of the show. It shows the S&P 500 equal weighted index versus dividend payers and dividend growers. So basically over 50 years, you can see that if you put in $1 and you got about $4,000 in 50 years, which is a huge return anyway, in the S&P 500. But if you had dividend payers, you would have gotten over 8,000. And if you had dividend growers and initiators, you would have gotten over 13,000. So you're talking about double or 3+ times. So whatever stocks you have, everybody has different needs and different allocations, different risk profiles. Some people want to put a lot in the market. Different people are young, and everybody knows this more or less. But the point is, whatever you have in the stocks should be in dividend payers in general, if you're basing it on the last 50 years history. So what to do, own energy, own dividends, and I'd still be very defensive. You know, I'll say one other thing. If I'm wrong and the market keeps going up, it's only gotten back to around where it was a year and a half ago. Against inflation, it lost a lot. But I wouldn't be surprised if we see a much lower market in the next year or so, or maybe it'll be a very gradual process where the market doesn't go up because the Fed just keeps rates high. But I don't think the market's view that rates are coming down soon and everything's going to be great because it's going to happen. I don't think there's any chance of that myself. So dividend stock of the week, and it's actually an MLP. I've discussed this before, but I'm going to discuss it again. First, some disclaimers, especially for our radio audience. This is for entertainment only. It's just our opinions. There's no guarantees, and also consult your financial advisor. That's all fact. We can't guarantee anybody, and anybody who says they can is either selling you a CD or just telling you things you want to hear. Okay, Energy Transfer. It's a limited partnership. I've discussed it before, but I'm going to discuss it again. Why? Well, I went with 3.5%, but now I've raised it. About a week or two, I raised it to 4. Now I'm at 4.5%. And that's part of a very big energy allocation that's mainly in pipelines, about 28%. 3% is hedged, so you say 25 to 26% maybe. So Energy Transfer, why do I basically love it a lot? I still like MPLX better, but one, it's a master limited partnership. So for most people, it has very big tax advantages. Here in the United States, you get depreciation, depletion, and return of capital before you're going to be taxed. And I believe it's taxed then at a capital gains rate after that. So a lot of tax advantages. Disadvantage, you get a K1. So if you own a lot of them, you can really raise your fees. So I try to own the bigger ones, outside my IRA and tiny ones in my IRA to keep the accounting down for the total amount. Also in an IRA, you have to be careful of something called UBTI. You can look that up. But it's a midstream pipeline company, first of all. And what I like about it is that I love the sector because for a lot of reasons. One, until about 2016, 2017, somewhere in there, it was getting 17% a year consistently. Then oil crashed. It wasn't doing too well for a few years, but generally it does phenomenally well. I believe it will continue to get huge returns because it's demand pull rather than push, something like that. So sorry for that. Anyway, the point is these pipelines do long-term contracts. People are heating their homes with the oil and gas that's coming through the pipelines. People are driving their cars. It's not changing. And so they're very steady and very high dividends. ET itself has a 9.5% dividend. Its price to cash flow, according to TD Ameritrade, is 4.1, which is phenomenal. That means it's getting almost 25% cash flow yield, somewhere in that range. And it's a cash machine, cash that can be used to return assets in dividends or distributions. Also, debt to assets is reasonable at 0.45. Usually I don't look at analysts a lot. I look a little bit at them. The price, I last looked at $12.95, although I think it's up a little today in the last day or so. But the average price for analysts is $17.50. So that's not a bad thing when you see about almost a 50% target above the price. But I do like to especially look at who owns a stock. I do that a lot. Goldman Sachs owns 434 million of ET. JP Morgan, and that, by the way, is substantial, even for Goldman Sachs. I mean, it's not a majority, and not their largest position, but it's one of their largest energy positions. Maybe number 2 or number 1. It's up there. I'd have to check, but it's way up there in terms of it's a nice investment. Even Goldman cares about $500 million. JP Morgan, 448 million, and also Morgan Stanley has a big investment too. 626 million. So each of these 3 companies, which I do like, all of them in terms of their analysis, putting in $500 million each into this. So that says something. I think that the pipeline business has a very nice future. Why? Number one, European LNG demand. They're building terminals all over the United States to ship Europe LNG. LNG is going to be needed in Europe for a long time, especially to replace Russian natural gas, which probably they don't want to use. And so there's a lot of demand there. 2, on the Shell side, world LNG demand. And the demand is forecast to exceed the supply by a lot. And number three, there's a good chance of possible carbon sequestration projects. There's a few out there now, and that will require pipelines too. So we better hurry. Panel discussion of the week. Question is AI, artificial intelligence, overhyped in the market? So quick background, and then we'll discuss it. Number one, as we've been discussing for weeks, 9 very large caps have been driving the market this year. And most of them are AI. Almost all of them are AI. If you count Tesla, it's partly AI, and they're all AI. So AI has been dominating the market. As a matter of fact, right now, because the NASDAQ is cap weighted, the 7 AI-oriented stocks make up 50% of the NASDAQ, the QQQ, I should say. And that means the QQQ is being revised because it's exceeding their limits in the next few weeks. So yes, okay, 7 great companies, but are they overvalued? So the market knows, there's a theory, the efficient market theory says the market should know all future available information. So maybe it's all priced in there and it's hype, maybe. As an example, concrete examples are NVIDIA has a gigantic PE ratio of 220. Now, an average stock that I would want to look at might have a PE of 10. So that means they have to grow earnings 22 times, and it's a big company already, just to get to something that I would like the PE ratio on. That's a lot of hype. Microsoft has a cash flow of roughly about 30, price over cash flow of 30. The average stock in the market has an price over cash flow in the S&P 500 about 14, and that includes the tech companies. So probably if you exclude them, it'd be like 10 or 11. So maybe Microsoft had to grow 2.5 times to get to the cash flow. And this is a big company. That's a lot of growth for big companies. Now, finally, this is some comments from Mark Reschino, who's a Gartner analyst, and he wrote a book called Mastering the Hype Cycle. And he said, as humans we're attracted to novelty. We tell our friends, so there's kind of social contagion. You get a sharp rise of excitement, but what's actually happening is the number of people applying or using the thing is often much slower. He talks about Bitcoin, and I'll give you the short version. Bitcoin streaming was supposed to be extremely profitable. Now it's turning out it was overhyped. 3D was going to dominate the world. It's still making money, but it's not dominating the world. So a lot of times there's excitement, there's expectations, and they're not met. Now, I know I do want to say this, AI is going to change the world. I mean, it's going to replace a lot of jobs. It's going to change a lot of how things operate. It's going to change how cars operate. It's going to change the world. But the question is the secret out, and is the market just hyping it? So, question, is it overhyped, Nick, or not?
Yes. The short answer is yes. The long answer is yes. It is the cryptocurrency of 2023. In other words,
or the metaverse, right?
Yeah, and we were actually playing with that this morning on one of our network shows because we're going to bring it in to some of our shows. But I've been playing with this for a half a decade, and frankly, the technology has not improved dramatically. What has improved dramatically is the marketing of the technology has improved dramatically. But the technology itself, I've been using for half a decade. All the chess players, all the video game players know about this technology. We've been using it for decades, since AlphaGo. So the thing is, there's nothing new.
You make a point. I mean, there's something here. Right. No, there is something. Look,
there's nothing dramatically new. It's the same old thing.
No, it's been coming for a long time. I think. Look, it's going to come. People are going to have robots in their home.
It's still.
But it's coming slowly, and the point is
long way to go. It's
it's a long way to
2023. Go. So I did buy into Palantir because that was done by Peter Thiel. I made a lot of money real quick, and I got out. The people that are going to make money in this have got to realize they're in a momentum situation. They got to get in, like cryptocurrency and get out without losing their tail when
Right.
the
It
thing
could be.
recedes
I
like,
mean,
when
yeah,
it recedes like a tidal wave that just came out. So
you
that's
could
where
be.
AI sits today.
You could be right. I mean, I know there's going to be money in it, but the question is it
When?
you look at Nvidia 22 times?
Oh, you
It
won't,
needs to
won't
grow
work me up
22
on
times.
Nvidia.
It's going to grow, but
Yeah.
but nobody knows. Here's the
No,
key point:
I-
nobody
they'll-
knows it. And I'm not
nobody
saying
knows.
don't buy tech. I'm
Yeah.
saying, first of all, if somebody forced me, they said, "Here's some extra dollars. You have to put it in a sector you don't like. You can't put it in
Right.
energy. You can't put it in certain consumer staples. You can't put it in
Yeah.
certain REITs. The shopping center REITs that I like. Certain areas." They say, "Okay, I'll add tech," but it's
Yeah.
speculative. It's
Speculative.
speculative at this price. And just like Bitcoin, it could go to, Bitcoin, I always say, it could go to $1 million or zero. But
Yeah.
in the long run, just like Buffett says, it's fundamentals that drive the market. Are the
Yeah.
fundamentals overhyped? Probably, because history shows most things are overhyped. Now, search engines weren't overhyped, and they did
Yeah.
Google and whatever. But out of everything that wasn't overhyped, there's a list of 20 things that are overhyped. So who knows, in the end.
Right.
But I would say that also AI is like, I have Google already. Is it really, in terms of certain information, I think Google or, another search engine is going to get me the same information as AI. I'd rather search it myself, But again, it depends where and when. We're going to have driverless cars. We're going to have all kinds of things. But
It's
if
gonna
the
be like-
market, the thing is, I think we're in a slow mo. That's the bottom line. I think what's going to happen is the Fed's going to raise. This is my final prediction because we're running out of time too. So I think the Fed's going to raise another time or two. I wouldn't be surprised. July for almost certain. Then they're going to keep the market, rates very high for a long time, and that's going to eat away slowly at the market. And if the market for tech or whatever starts going down and people start going into panic mode, maybe, then AI can go anywhere because nobody knows if these stocks are worth this tremendous value that everybody's putting it on. But
Right.
based on the efficient market theory, somebody was wrong either 6 months ago, as you said, Nick, or now, because the market's mainly AI is driven through the roof. But the same information is available 6 months ago and now. So it's almost like if there's an efficient market, the market was wrong 6 months ago or now. But either way, there's something going on that we will see. So I'll stay with the tried and true and, earn my dividends, get my growth with my stock allocation, buy long-term bonds. Because, in the end, I do predict rates are going to go to zero very likely in the next 5 to 7 years. So
Right.
unfortunately, we're out of time for the show.
Yep.
But we'll be on next week, same time, same station. And they used to say that, I think, on Batman. Anyway, thanks for watching. And as Kim always says, get healthy, get wealthy, and we'll see you soon.
See you next week. Bye-bye.